There's a pattern in economic history that has destroyed three major economies in the last 100 years. And right now, in 2025, the United States is following that exact same pattern stage by stage, debt payment by debt payment, almost like we're reading from the same textbook that led to catastrophe every single time before. In 1918, Germany emerged from World War I with impossible debts. The Weimar Republic tried to pay. They borrowed more. They printed money. By 1923, a loaf of bread cost 200 billion marks. The currency died, savings evaporated, the middle class was destroyed, and the economic chaos created the conditions for what came next. Everyone knows how that story ended. In 1982, Mexico announced it couldn't pay its debts. Within months, the entire Latin American continent was in crisis. Brazil, Argentina, Chile, 300 billion in unpaid loans. A decade of economic depression followed. They called it the lost decade. 20 years of development erased. An entire generation sacrificed to pay foreign banks. In 2010, Greece admitted it had been hiding its debt for years. The real numbers were catastrophic. The EU forced austerity. The economy contracted 25%. Unemployment hit 28%. Young people fled the country. Suicide rates doubled. The Greek economy still hasn't recovered 15 years later. 3 times, 3 economies, 3 debt spirals that destroyed everything. And here's what should terrify you. The United States has already completed 5 of the 7 stages. We're not approaching the pattern. We're deep inside it. This is the story of how nations borrow themselves to death, why they always think this time is different, and why the math says America is next. And it's happening faster than anyone in power wants to admit. Before we go through the pattern, you need to understand what a debt spiral actually looks like. Not in economics textbooks, in practice. What it means when a country loses control of its debt. A debt spiral doesn't start with default. It starts with confidence. A nation borrows to invest. Infrastructure, military, education. The investments pay off. GDP grows. The debt is manageable. Everything seems fine. But then something shifts. The borrowing continues, but the investments stop. Now you're borrowing to maintain living standards, to fund government operations, to pay pensions and welfare. You're borrowing to avoid making hard choices. And then you cross the threshold. You're borrowing just to pay the interest on previous borrowing. The debt grows faster than the economy. The math stops working. And everyone who said debt doesn't matter suddenly realizes it's the only thing that matters. That's not theoretical. That's what happened to Germany, to Latin America, to Greece. And it happened because they made exactly the same decisions we're making now. Let's start with the original modern debt spiral. Weimar Germany, 1918 to 1923. This is the blueprint for how quickly it can all fall apart. November 1918, Germany surrenders. World War I is over, and the Allies, particularly France, want revenge. The Treaty of Versailles, signed June 1919, demands reparations. 132 billion gold marks. That's roughly $442 billion in today's money. Germany's entire GDP at the time was maybe 60 billion marks. Let that sink in. They were being asked to pay 2.2 times their entire economic output. It was impossible from day one. Stage 1. Borrow for investment and growth. But Germany tried. The Weimar Republic borrowed from anyone who would lend. British banks, American banks, private investors. They needed the money to rebuild the country, restart industry, employ millions of returning soldiers. At first it worked. From 1919 to 1921, German industrial production recovered. Factories reopened. People went back to work. The government was popular. They were managing the debt. This is where the pattern begins. When debt is used for productive investment, it seems sustainable. The economy grows. Tax revenues increase. You can service the debt. Germany looked stable. Stage 2. Debt becomes structural. But the reparations payments kept coming. 2 billion marks per year. That's money leaving the economy permanently. Not investment, not growth, just gone. Paid to France and Britain. To make the payments, Germany had to borrow more. But now they weren't borrowing to invest. They were borrowing to pay other debts. The debt became structural, a permanent feature of the budget that couldn't be eliminated. By 1922, Germany's debt had exploded to 300 billion marks. Foreign lenders were getting nervous. Interest rates started rising. The government needed more revenue, but raising taxes was politically impossible. The population was already suffering, so they made the fatal decision. Stage 3. Borrowing to pay interest. In 1922, Germany couldn't borrow enough to make the reparation payments. Private lenders weren't interested anymore. The risk was too high. So the Weimar government did what every failing government does. They started printing money. The Reichsbank began creating marks out of thin air, not to invest in the economy, to pay debts. They were printing currency to cover what they couldn't borrow. This is the point of no return. When a government starts monetizing debt, printing money to pay bills, the mathematics of collapse become inevitable. Stage 4. Loss of credibility. By late 1922, everyone holding German marks knew what was happening. The currency was being debased. Inflation started accelerating. What cost 1 mark in January cost 10 marks by December. Foreign creditors panicked. France and Belgium invaded the Ruhr industrial region in January 1923, seizing factories to take reparations directly. Germany ordered workers to strike in protest. Now they had to print even more money to pay striking workers who were producing nothing. The currency markets lost all faith. The mark went into free fall. Stage 5. Death spiral begins. 1923 was the collapse. This is what a true death spiral looks like in real time. In January 1923, $1 bought 18,000 marks. By August, $1 bought 4.6 million marks. By October, $1 bought 25 billion marks. By November, $1 bought 4.2 trillion marks. Let me give you what that meant in practice. In early 1923, a loaf of bread cost 250 marks. By September, 1.5 million marks. By November, 200 billion marks. Prices were doubling every few days, then every few hours. People were paid twice a day and ran to spend the money immediately before it lost half its value. Wheelbarrows full of cash to buy groceries. Paper money was literally worth less than the paper it was printed on. People burned it for heat. Stage 6. The choice. The Weimar government faced the impossible choice every debt spiral nation faces. Option 1. Default on the debt. Admit you can't pay. This destroys your credit for a generation and triggers immediate economic depression. Option 2. Keep printing money. This destroys your currency and wipes out savings, but keeps the government functioning. Option 3. Impose brutal austerity. Slash spending, raise taxes, pay the debt. This triggers economic depression and usually revolution. Germany chose option 2. They kept printing, and the currency died. Stage 7. Collapse. By November 1923, the mark was worthless. The entire German middle class had their savings obliterated. Anyone with a bank account, insurance policy, or pension in marks destroyed. Lifetime savings gone overnight. The government finally stabilized by introducing a new currency, the Rentenmark, backed by property. They essentially reset the economy. 1 Rentenmark equaled 1 trillion old marks. The social consequences were catastrophic. The middle class destroyed. Faith in democracy destroyed. Economic stability destroyed. And into that chaos walked extremists promising to restore German greatness. We know how that ended. That's what debt spiral collapse looks like. Let's jump forward 60 years. Latin America, 1970s to 1980s, the lost decade. This one is different because these weren't war debts. This was sovereign borrowing in a globalized financial system. And it proves the pattern works the same way regardless of context. Stage 1. Borrow for investment and growth. In the 1970s, Latin American countries, Mexico, Brazil, Argentina, Chile, Venezuela, were booming. Commodity prices were high. Oil, copper, coffee, soybeans, these countries exported everything the world wanted. And Western banks, flush with petrodollars from OPEC countries, were desperate to lend. Interest rates were low, money was cheap. Latin American governments borrowed billions to build infrastructure. highways, dams, airports, steel mills. From 1970 to 1980, Latin American debt went from $75 billion to $315 billion, 4 times larger in a decade. But it seemed fine because the investments were real. Brazil was building the modern economy of the future. Mexico had oil. Argentina had agriculture. The money was going toward productive capacity. Stage 2. Debt becomes structural. But here's what was actually happening. A lot of that borrowed money wasn't going to infrastructure. It was going to subsidies, state-owned enterprises, government employment, social programs, corruption. The debt stopped being about investment and started being about maintaining living standards. Brazil borrowed to keep gas prices low. Argentina borrowed to keep beef prices low. Mexico borrowed to maintain government payrolls. By 1980, Latin American governments were running permanent deficits funded by foreign loans. The debt had become structural. They couldn't balance their budgets without borrowing. And that might have continued indefinitely if the world hadn't changed. Stage 3. Borrowing to pay interest. 1979. The Federal Reserve, under Paul Volcker, raised interest rates to crush U.S. inflation. The Fed funds rate went from 11% in 1979 to 20% by June 1981. That decision changed everything for Latin America, because almost all their debt was denominated in U.S. dollars, with variable interest rates tied to U.S. rates. Suddenly their interest payments doubled, then tripled. Mexico's debt service went from $6 billion in 1978 to $12 billion in 1982. Same debt, double the cost. But commodity prices were collapsing at the same time. Oil prices fell, copper prices fell. Their export revenues were shrinking while their debt payments were exploding. Now they were borrowing just to pay interest on previous loans. Not investing, not growing, just servicing debt. Stage 4. Loss of credibility. By 1982, the market figured out the math didn't work. Mexico alone owed $80 billion. Their entire GDP was $285 billion. Debt service was consuming 40% of export revenues. Foreign banks stopped rolling over loans. No new money coming in. And Latin American countries couldn't make their payments. August 12, 1982. Mexico's finance minister flies to Washington and tells the U.S. Treasury and IMF that Mexico will default on Monday. They're out of dollars, they can't pay. This is what loss of credibility looks like. Instant. Total. The market turns off like a switch. Stage 5. Death spiral begins. Within weeks, the entire continent was in crisis. Brazil announced it couldn't pay, $87 billion in debt. Argentina, $43 billion. Chile, Venezuela, Peru. Everyone was insolvent simultaneously. The banks panicked. $300 billion in loans were about to default. U.S. banks had lent $80 billion, more than their entire capital base. If Latin America defaulted, it would collapse the American banking system. The IMF stepped in with emergency loans, but the conditions were brutal. Stage 6. The choice. Latin America faced the same impossible choice: default, inflate, or impose austerity. They chose austerity. The IMF demanded spending cuts, subsidy elimination, currency devaluations, tax increases, privatization of state assets, and it destroyed their economies. Stage 7. Collapse. The 1980s in Latin America, the lost decade. Mexico's economy contracted. Per capita income fell 20%. Real wages fell 40%. Brazil's inflation hit 2,000% per year by 1989. Argentina's economy collapsed entirely. Inflation hit 3,000% in 1989. An entire decade of economic development erased. Poverty doubled. The middle class was crushed. Capital flight, brain drain, political instability, and the debt. They kept paying. But it took 20 years to recover to 1980 income levels. 20 years. An entire generation sacrificed to service debt to New York banks. The lesson: when external conditions change and you're over-leveraged, there is no good option, only catastrophe. Now let's look at the most recent example. One that's close enough that some of you lived through it. Greece, 2001 to 2015. This is the most important example because it happened in a modern, developed Western democracy, a EU member. This wasn't a developing country or post-war economy. This was us. Stage 1. Borrow for investment and growth. January 1st, 2001. Greece joins the Eurozone. For the first time in modern history, Greece can borrow at the same interest rates as Germany. The markets see Greek bonds as nearly risk-free because they're denominated in euros, backed by the EU. Greek government bonds that used to yield 18% were now yielding 5%. That's a 72% reduction in borrowing costs. Free money. Greece borrowed $200 billion in the 2000s. Some went to infrastructure, roads, airports, preparation for the 2004 Athens Olympics. But most went into consumption. Government hiring, pension increases, public sector wages that doubled between 2000 and 2009. Stage 2. Debt becomes structural. But here's what nobody knew. Greece was lying about its debt. The Greek government, with help from Goldman Sachs, had been using complex financial derivatives to hide borrowing and make their budget deficit appear smaller than it actually was. They were literally cooking the books. By 2009, Greece's official budget deficit was supposed to be 3.7% of GDP. The actual number? 15.4%, 4 times higher. The debt was structural. The government couldn't function without borrowing. Public sector employment had exploded. Pensions were unsustainable. Tax collection was a joke. Half the economy was underground, paying no taxes. Stage 3. Borrowing to pay interest. October 2009. Greece's new government admits the real numbers. The deficit is 15.4%. The debt is 127% of GDP, not the 99% they'd been reporting. The bond market freaked. Greek bond yields spiked from 5% to 8% overnight, then 10%, then 12%. Suddenly Greece was paying twice as much to borrow. But they had to keep borrowing because they couldn't make their debt payments without new loans. They were borrowing to pay interest. Stage 4. Loss of credibility. April 2010. Greece is locked out of bond markets. Nobody will lend. Yields hit 15%, then 20%. That's a death sentence. At 20% interest, the debt becomes impossible to service. Greece turns to the EU and IMF for a bailout. 110 billion in emergency loans. But the conditions are brutal. Pension cuts, public sector wage cuts, tax increases, privatization. The Greek people riot. The government collapses. Elections. Another bailout. Another government collapse. The spiral accelerates. Stage 5. Death spiral begins. 2011-2012. This is what a modern debt spiral looks like in real time. Greek bond yields hit 30%, then 40%. By March 2012, 2-year Greek bonds were yielding 450%. 450%. That's not a bond market. That's a bankruptcy signal. The economy contracted 25% between 2008 and 2013. Quarter of the entire economy, gone. Unemployment hit 28%. Youth unemployment hit 60%. People couldn't find work. Banks ran out of money. Capital controls were imposed. Greeks could only withdraw $60 per day from ATMs. Savings accounts frozen. Stage 6. The choice. Greece faced the impossible choice in 2015. The new government led by Alexis Tsipras held a referendum. Should Greece accept more austerity to stay in the euro or default and leave? Option 1, accept austerity. More cuts, more pain, but stay in the euro and keep access to EU support. Option 2, default, leave the euro, print drachmas. This triggers immediate banking collapse and economic chaos, but ends the austerity death spiral. The Greek people voted no to austerity. 61% voted to reject the bailout terms. 1 week later, the Greek government accepted the bailout anyway, because the alternative, leaving the euro, printing a new currency, would have been worse. Bank runs, currency collapse, import shortages, economic isolation. They chose austerity. Stage 7, collapse. The Greek depression lasted 8 years, By 2016, the economy had contracted 25%. That's Great Depression level. Real wages fell 30%, pensions cut 40%, public services collapsed, hospitals ran out of medicine, suicides doubled, 400,000 young Greeks emigrated, brain drain. Greece still hasn't recovered. 15 years later, GDP is still below 2008 levels. An entire generation lost their prime earning years to debt service. The Greek government is still paying the bailout loans. They're projected to finish in 2060. 45 years of payments to pay for 1 decade of overspending. That's the price of a debt spiral. And Greece didn't even have the option of printing money. They were locked into the euro. At least they avoided hyperinflation. The lesson of Greece. In a modern financial system with global capital markets, the death spiral can happen in months, not years. And there is no escape once it starts. 3 economies, 3 different contexts, 3 identical patterns. Weimar Germany, Latin America, Greece. Different decades, different currencies, different political systems, but the exact same 7-stage death spiral. Let's break it down, because once you see it, you'll understand why what's happening in the United States right now should terrify you. Stage 1. Borrow for investment and growth. In all 3 cases, the borrowing started for legitimate reasons. Germany needed to rebuild. Latin America needed infrastructure. Greece wanted to modernize. When debt is used for productive investment that generates economic returns, it's sustainable. Build a highway, trade increases, tax revenues rise, you can pay back the loan. The math works. This alone isn't dangerous. This is normal. Check. Stage 2. Debt becomes structural. But in all 3 cases, the borrowing continued after the productive investments were done. Germany was paying reparations. Latin America was subsidizing consumption. Greece was hiring government workers. The debt stopped being temporary and became permanent. Every year, the budget required new borrowing just to function, not to invest, not to grow, just to maintain operations. When debt becomes structural, when you can't balance your budget without borrowing, you've crossed a line. The math starts to get harder. Check. Stage 3. Borrowing to pay interest. This is the mathematical point of no return. When your debt grows faster than your economy, when interest payments consume an increasing share of your budget, when you're borrowing new money just to pay interest on old money, the spiral has begun. Germany was printing marks to make reparation payments. Latin America was borrowing to make interest payments to New York banks. Greece was taking EU loans to pay previous EU loans. This is when smart people start leaving. This is when capital flight begins, because everyone who understands math can see where this ends. Check. Stage 4. Loss of credibility. In all 3 cases, there was a specific moment when the market stopped believing. The currency collapsed. Bond yields spiked. Credit markets froze. Germany, January 1923. Foreign exchange markets gave up on the mark. Latin America, August 1982. Banks stopped rolling over Mexican debt. Greece, April 2010. Bond yields spiked above 15%. When credibility is lost, everything accelerates. This is usually triggered by external shock. Interest rate change, commodity price collapse, hidden debt revelation. But the underlying problem was already there. The shock just reveals it. Check. Stage 5. Death spiral begins. This is the rapid acceleration phase. The period measured in months, not years, where everything falls apart. The currency collapses, or bond yields spike to unsustainable levels, or both. The government can't borrow at any price. Economic activity contracts. Tax revenues fall. Deficits get worse. The need for borrowing increases at the exact moment borrowing becomes impossible. Germany, 1923. Hyperinflation destroys the mark in 11 months. Latin America, 1982-1983. Entire continent locked out of credit markets. Greece, 2010-2012. Economy contracts 25% in 5 years. The death spiral is when the mathematical reality overwhelms the political will to fix it. Check. Stage 6. The choice. Every debt crisis reaches a point where there are only 3 options, and all of them are catastrophic. Option 1. Default. Stop paying. This destroys your credit rating, triggers immediate economic depression, and often revolution. Argentina 2001, Russia 1998. Germany almost chose this, but France invaded. Option 2, inflate. Print money to pay the debt. This destroys your currency, obliterates savings, but keeps the government functioning short-term. Germany 1923. Every hyperinflation in history, the government survives, but the people are destroyed. Option 3, austerity. Slash spending, raise taxes, pay the debt through economic depression. This saves your credit rating but destroys your economy and usually triggers political collapse. Latin America 1980s, Greece 2010s, 3 options. All catastrophic. The only question is, who suffers most? Check. Stage 7, collapse. This is the final state. The economic depression, the currency death, the social breakdown, the political chaos. Germany, hyperinflation, middle-class destruction, rise of extremism. Latin America, lost decade, poverty doubled, 20-year recovery. Greece, 25% economic contraction, youth emigration, still hasn't recovered. And here's the pattern within the pattern. The collapse never affects the people who caused it. The elites protect their wealth. The costs are borne by the middle class and poor. German elites converted their marks to foreign currency or property. They survived. Latin American elites had dollar accounts in Miami. They survived. Greek elites moved their money to Switzerland before the crisis. They survived. It's always the middle class that gets destroyed. The people with savings in the local currency. The people who believed the government when it said everything was fine. The people who didn't see the pattern until it was too late. That's the pattern, 7 stages, and it never fails. Now let's talk about the United States in 2025 and why every warning sign is flashing red. Stage 1, borrow for investment and growth, complete. The United States completed this stage decades ago. Post-WWT borrowing built the interstate highway system, the space program, the internet, research universities, infrastructure that generated returns. That's over. We're long past that stage. Check. Stage 2. Debt becomes structural, complete. U.S. federal debt is now permanent. We haven't had a balanced budget since 2001. We haven't had a surplus that meaningfully reduced debt since the late 1990s. The debt has gone from $5.8 trillion in 2001 to $36 trillion in 2025. We added $30 trillion in debt in 24 years. And none of it went to productive investment. It went to 2 decades of wars in Iraq and Afghanistan, $8 trillion, bank bailouts in 2008, $700 billion direct, trillions more in guarantees, COVID stimulus, $5 trillion, tax cuts that weren't paid for, trillions more, Medicare and Social Security deficits every single year. We're not borrowing to invest. We're borrowing to maintain living standards, to avoid making cuts, to fund entitlements we can't afford. The debt is structural. Every year, the baseline budget deficit is $1.5 to $2 trillion in a growing economy. During peacetime, the deficit never goes away. Check. Stage 3, borrowing to pay interest, complete. In fiscal year 2024, the United States paid $892 billion in interest on the national debt. That's more than we spent on defense, more than we spent on Medicare, more than everything except Social Security. By 2025, interest payments will exceed $1 trillion per year. Here's the math that should terrify you. At current interest rates and debt levels, interest costs are growing faster than the economy. In 2020, interest was 1.6% of GDP. In 2025, it's 3.2% of GDP. It's doubled as a share of the economy in 5 years. And it's accelerating. Every year we borrow $2 trillion. That new borrowing requires interest payments. Those interest payments require more borrowing. We're borrowing to pay interest on previous borrowing. The doom loop has started. Check. Stage 4, loss of credibility, in progress. We're here right now. And most Americans don't realize it yet because it's happening slowly, then suddenly. The signs. U.S. Treasury auctions are seeing weaker demand. Foreign buyers are reducing purchases. China has reduced its Treasury holdings from $1.3 trillion in 2013 to $775 billion in 2024. They're selling. Japan, the largest foreign holder, is selling treasuries to support the yen. Domestic demand is increasingly from the Federal Reserve, which means money printing. Credit rating agencies have started downgrading U.S. debt. Fitch downgraded the U.S. from AAA to AA+ in 2023. Not because we'll default, because the debt trajectory is unsustainable, and the political system can't fix it. Debt ceiling fights every year. Shutdown threats. January 6th. Political paralysis. The world is watching and asking, can America govern itself? When credibility starts to crack, it doesn't happen all at once. It's a slow leak. Then suddenly the dam breaks. We're in the slow leak phase. Check. Stage 5. Death spiral begins forming. This hasn't happened yet, but the pieces are in place. Here's what Stage 5 looks like when it arrives. Treasury yields spike. The 10-year note goes from 4.5% to 6%, then 8%. Suddenly, our $2 trillion annual deficit becomes $3 trillion because interest costs explode. The Fed faces a choice: let yields rise and crash the economy, or print money to buy bonds and risk inflation. Foreign holders accelerate selling. Capital flight. The dollar starts to weaken significantly as global reserve currency. We're not there yet. But we're closer than most people think. The trigger could be anything. A failed treasury auction where demand is insufficient, a geopolitical crisis that spooks bond markets, inflation returning and forcing the Fed to raise rates, a major economic downturn that explodes the deficit, a political crisis that convinces markets we can't govern. The kindling is dry. The debt is $36 trillion, interest costs are $1 trillion and rising. The deficit is structural. Political reform is impossible. We're just waiting for the spark. Stage 6. The choice, not yet, but visible. The United States will face the same choice every debt spiral nation faces, and we can already see the factions forming. Option 1. Default. Politically impossible for the U.S. We can't default on Treasury bonds. It would destroy the dollar as reserve currency and collapse the global financial system. But it will be advocated by populists on both left and right who say, cancel the debt, start over. Option 2. Inflate. This is the most likely path. The Fed will print money to buy treasuries, monetizing the debt. Keep interest rates artificially low. Accept 6 to 10% annual inflation as the price of avoiding default. This destroys savings slowly and transfers wealth from creditors to debtors. The middle class gets crushed, but the government survives. Option 3. Austerity/Social Security/Medicare. Massive spending cuts, huge tax increases. This is politically impossible in America. Any politician who proposes real austerity gets voted out immediately. But if forced by crisis, it triggers depression. 3 options, all catastrophic. The debt to GDP ratio is 120% and rising. At what level does the market lose faith? 150%? 200%? Nobody knows. But every debt crisis in history started with people saying, it's different this time. It's never different. Stage 7. Collapse. The destination. We're not here yet, but this is where the math leads. What would Stage 7 look like in America? Scenario A. Hyperinflation path, like Germany. The Fed prints to pay the debt. The dollar loses 50%, then 70%, then 90% of its value. Imports become unaffordable. Gas $20 a gallon. Grocery prices double annually. Savings evaporated. Middle class destroyed. Social unrest. Possible political collapse. Scenario B. Default path, like Argentina. The U.S. defaults on treasury bonds. The dollar crashes. Credit markets freeze. Economic depression. Unemployment 15 to 20%, bank failures, international isolation, reserve currency status lost, China and EU benefit. Scenario C, austerity depression, like Greece, forced spending cuts. Social Security cut 30%, Medicare cut 40%, mass unemployment, economic contraction 20–30%, civil unrest, political fragmentation, possible secession movements. Scenario D, hybrid chaos, like Latin America 1980s, some combination of all three. Selective default, high inflation, deep cuts, a lost decade or two. Stagnation, political extremism, decline from superpower to regional power, that's stage 7. And the pattern says once you're in stage 4, which we are, stage 5 and 6 come faster than anyone expects. 3 debt spirals, 3 identical 7-stage patterns. Germany, Latin America, Greece. Each time the people in power said, it's different this time. Germany said they had to pay reparations. They had no choice. Latin America said commodities would stay high forever. Greece said the EU would protect them. They were wrong every single time. The United States is in stage 4. Our debt to GDP ratio is higher than France in 1789 before the Revolution, higher than Britain in 1945 after World War II, higher than Japan in 1990 before their lost decades. Our interest costs are exceeding our defense spending. Our deficit is structural and permanent. Our political system is too paralyzed to reform. Our foreign creditors are slowly backing away, and the pattern says stage 5, 6, and 7 are coming. Maybe we can stop it. Maybe we can reform. Maybe we can grow our way out. Maybe AI will create massive productivity gains that make the debt manageable. Maybe inflation will erode the real value of the debt without causing a crisis. Maybe. But the pattern says otherwise. The math says otherwise. The history says otherwise. American exceptionalism says we're different. We have the reserve currency, we print dollars, we can't fail. That's what Britain said in 1945. That's what every empire says before it collapses. We're telling ourselves the same lies Germany told itself in 1922. Inflation is temporary. We can manage this. The economy will grow. We'll figure it out. They didn't figure it out. Neither did Latin America. Neither did Greece. 3 times the pattern played out, stage by stage, each time ending in economic catastrophe, each time destroying the middle class while the elites escaped. The United States is on the same path. The math is worse. The politics are more broken. The timeline is shorter because modern financial markets move faster than they did in 1923 or 1982. We're not approaching the death spiral. We're in it. Stage 4. And history says stage 5 accelerates fast. If this opened your eyes to where we actually are in the debt spiral, subscribe. Because when stage 5 begins, when Treasury yields spike and the Fed faces the impossible choice between depression and inflation, you'll want to understand what's happening and why. The pattern has played out 3 times in the last 100 years. The mathematics are identical. The stages are identical. The outcome is always the same. The answers aren't hiding in complex economic theories. They're written in the history books, in the ashes of Germany, in the lost decades of Latin America, in the depression of Greece. And I'll show you where to look.